What if I told you that this week, the world moved closer to a potential conflict over the most important oil choke point on Earth? Crude oil exploded higher by over 10%. And yet gold, the so-called ultimate safe haven, didn't rally. It fell. It fell 3.5%. That contradiction should stop you in your tracks because it tells you something very specific about what markets are actually afraid of right now, and it is not what you think. Let me show you what really happened this week, why every major asset class just sent you a warning signal, and exactly what this means for how you should be thinking about your portfolio. Stay with me because by the end of this video, you will see a pattern in this data that most people are completely missing. Let's start with the domino that set everything in motion this week. Oil. West Texas Intermediate crude didn't just move, it detonated, up 10.48% in a single week. That is one of the largest weekly moves we have seen in years, and the reason is splashed across every headline. Tensions around Iran and the Strait of Hormuz reached a boiling point. Trump says Xi Jinping agrees Iran must open the strait. China fires back, saying the war should not have started in the first place. China's UN ambassador publicly criticizes the U.S. Hormuz resolution. You have got geopolitical brinkmanship playing out in real time over the waterway through which roughly 20% of the world's oil passes every single day. Now here is where the dominoes start falling. When oil spikes like this, what does the market immediately start pricing in? Inflation. And when inflation expectations rise, what happens to bonds? They get crushed. The 10-year Treasury yield surged to 4.59%, climbing over 5% in just 1 week. The 30-year yield punched through 5% and settled at 5.13. Let me put that in context. A 30-year yield above 5% is a level we have not seen consistently in nearly 2 decades. The iShares 20-plus year Treasury bond ETF, ticker TLT, bled 2.81%. The broad bond market, as measured by the aggregate bond ETF, dropped 1.17%. Even high-yield corporate bonds, which usually hold up better when the economy looks okay, still fell 0.85%. So bonds got destroyed, oil is surging, inflation fears are back, and now watch what that did to the next domino, real estate. The Vanguard real estate ETF dropped 2.80% this week, and it makes perfect sense because real estate investment trusts are essentially long-duration income assets. When yields spike, REITs suffer. It is almost mechanical. But I will show you in a minute why this move in real estate combined with what happened in small caps might be screaming something very specific about where the economy is headed. Speaking of small caps, the Russell 2000 did not just underperform. It was the worst performing major equity index by a mile, falling 2.37%. Meanwhile, look at the large cap world. The S&P 500 eked out a gain of 0.13%, barely positive but positive. The Nasdaq was essentially flat, down just 0.08%. The Dow slipped 0.17%. So you have this massive divergence. Large caps, particularly the mega cap tech and AI names, are holding the market together like duct tape on a cracking dam, while everything underneath, small caps, real estate, bonds, is falling apart. That divergence is not sustainable, and I am going to break down exactly why in a moment. Now let me get back to the contradiction I opened with because it is the most important signal of the week. Gold. Gold futures dropped 3.49% to 4,555.80. In a week where geopolitical tensions escalated dramatically, where oil spiked, where you would expect every investor on the planet to be running toward the classic safe haven, gold went the other direction. Why? Because gold has a nemesis, and that nemesis is real yields. When Treasury yields surge the way they did this week, and especially when those yields are rising faster than inflation expectations, the opportunity cost of holding gold, which pays you nothing, becomes enormous. Money flowed out of gold and into the safety of short-duration treasuries or simply into cash equivalents. The market is telling you that right now it is more afraid of an inflation and interest rate spiral than it is of geopolitical conflict. Let that sink in. And here is one more piece of the puzzle before we get into what all of this means for your portfolio. Market sentiment is sitting at 62.9 out of 100. That is solidly in greed territory. Investors are greedy despite bonds collapsing, despite small caps bleeding, despite oil surging on war fears. The greed is concentrated in one place: large cap tech and AI. Jefferies put out a note this week saying the AI rally remains supported by strong earnings growth. Cerebra's, an AI chip company, soared 68% on its IPO day. The market is making a very aggressive bet that mega-cap AI is the only game in town, and everything else can burn. That kind of narrow leadership is exciting on the way up, but historically, it is one of the most dangerous setups when it unwinds. So what does all of this mean for your portfolio? Let's dig in because this is where it gets really practical. First, let's talk about the classic 60-40 portfolio. 60% stocks, 40% bonds. This week, that portfolio got hit from both sides. Your equity allocation, if it was broad and diversified with small caps and real estate exposure, was dragged down significantly. Your bond allocation, which is supposed to be the ballast, the shock absorber, lost between 1 and nearly 3% depending on duration. This is the nightmare scenario for 60-40 investors. Stocks and bonds moving down together. And the reason they are moving together is the same reason they moved together in 2022. Inflation. When yields rise because of inflation fears, bonds lose value. And when those same rising yields start choking the economy, stocks, especially rate-sensitive ones, also lose value. The diversification benefit of bonds disappears in an inflationary regime. If you are running a 60-40 and you have not stress-tested it against this exact scenario, this week was your wake-up call. Now let's talk about cross-asset correlations. The fact that gold fell alongside bonds is unusual and important. Normally, in a geopolitical shock, you would expect gold to rise and bonds to rise as flight-to-safety assets. Neither did. This tells you the dominant force in markets right now is not fear of war. It is fear of inflation and higher for longer interest rates. That is a critical distinction because it changes what actually hedges your portfolio. In this environment, traditional hedges like long-duration treasuries and gold are not working. What is working? Consumer staples. The Consumer Staples Select Sector SPDR was up 0.55% this week. It was one of the only things in the green besides the narrowest slice of mega-cap tech. Staples companies can pass through higher input costs to consumers. They are inflation beneficiaries, not inflation victims. There's a clear rotation signal happening beneath the surface. Money is leaving small caps, leaving real estate, leaving rate-sensitive sectors and concentrating into two buckets. Mega-cap growth, particularly AI-related names and defensive staples. That is a barbell. It is a barbell that says the market believes either the economy reaccelerates through AI productivity or it slows down and you need defensive positioning. There is very little middle ground being priced in right now. The middle of the market, the cyclicals, the small industrials, the regional banks that live inside the Russell 2000, those are being abandoned. And that brings us to the risk indicators. Unemployment is at 4.3%. That is elevated compared to where it was a year ago. The yield curve spread between the 10-year and 2-year is at 50 basis points, which is normal and no longer inverted. But here is the thing. The yield curve uninverting is not the all-clear signal people think it is. Historically, the recession often begins after the curve normalizes, not while it is inverted. The inversion is the warning. The normalization is when the damage actually starts showing up in the real economy. Combine that with small caps getting crushed and real estate falling, and you have a setup that demands your attention. So what should you be thinking about? Let me give you a framework, not financial advice, but an educational way to approach this data. If you are running a traditional balanced portfolio, this week showed you that duration risk, meaning exposure to long-dated bonds and rate-sensitive assets, is the single biggest vulnerability right now. The TLT lost nearly 3% in 1 week. A Vanguard real estate ETF lost about the same. If you have heavy allocations to either, you need to understand that in an environment of rising yields, those positions are working against you, not for you. The all-weather portfolio, the Ray Dalio-inspired approach that holds stocks, long-term bonds, gold, and commodities, would have had a mixed week. The commodity sleeve, particularly any oil exposure, would have surged and partially offset the losses in bonds and gold. But the long-term Treasury position would have been a significant drag. This is actually a relatively rare week, where the all-weather approach shows its strength through commodity diversification, while also exposing its weakness through gold and bond correlation. For defensive positioning, consumer staples are quietly doing their job. Utilities, on the other hand, are not. The Utilities Select Sector SPDR fell 1.9% because utilities are essentially bond proxies. They carry high debt loads and their dividend yields compete with Treasury yields. When the 10-year is at 4.6 and rising, utilities lose their appeal. So if you are looking for defense, staples over utilities in this environment is the framework to consider. Now here are 2 specific things to watch next week that could shift your allocation thinking significantly. Number 1, the FOMC minutes drop on May 20th. The Federal Reserve's minutes from their last meeting will give us the most granular look at how Fed officials are thinking about this exact inflation versus growth tension. If the minutes reveal that multiple members discuss the possibility of rate hikes, not just holding rates steady, but actual hikes, that would be a seismic shift that could accelerate the bond sell-off and hit equities hard. On the other hand, if the minutes show the Fed is more concerned about economic slowdown than inflation, bonds could rally sharply and reverse this week's damage. Number 2, building permits and housing starts data come out on May 21st. With the 30-year yield now above 5%, mortgage rates are likely pushing towards 7.5% or even 8%. If housing starts collapse, it will confirm that the rate spike is already strangling one of the most important sectors of the economy. That would be a recessionary signal. If housing somehow holds up, it would suggest the economy is more resilient than the bond market is pricing in. Either outcome matters enormously for your portfolio. Now let me zoom out and tie all of this together, because the bigger picture is where the real insight lives. We are in a moment that feels eerily similar to the mid-2022 regime, but with an added geopolitical accelerant. Back then, inflation was surging, the Fed was hiking, bonds and stocks were falling together, and narrow mega-cap leadership was masking deep underlying weakness. Today, we have a similar dynamic, but now with a potential military escalation around the Strait of Hormuz acting as a gasoline can sitting next to the inflation fire. If that strait gets disrupted even temporarily, oil does not go to 115. It goes to 140, 150. And at those levels, the inflation math changes for every central bank on the planet. The market is telling you 3 things right now if you are willing to listen. 1, inflation is not dead. The bond market is screaming it with a 30-year yield above 5%. 2, the economy is bifurcating. Mega-cap tech is in its own universe while the rest of the economy, represented by small caps and real estate, is showing real stress. And 3, traditional hedges are broken in this regime. Gold and long bonds are not protecting you when the threat is inflation, not deflation. The investors who will navigate this successfully are the ones who understand that asset allocation is not static. It is a living, breathing framework that must adapt to the regime you are actually in, not the regime you wish you were in. And right now, the regime is one of rising yields, geopolitical uncertainty, narrow equity leadership, and an inflation pulse that refuses to flatline. If this breakdown helped you see the market more clearly, Hit that subscribe button and turn on the bell because every single week I am going to be here breaking down the data that actually matters for your money. Drop a comment below and tell me, are you more worried about inflation or recession right now? I read every single comment and your answers help shape what I cover next week. I will see you in the next one.